Thank you so much. This has been, a great experience for me. And I appreciate getting to meet each and every one of you. So I'm going to turn that over to Antonio before I keep talking as well. All right.
So I'd rather not hold on. I want to thank Joyce and Israel for inviting me to speak with everyone here a little bit about the mortgage process and also the housing market. I've helped Joyce, and also I saw Hawa here. I don't know where she went, but with finding housing just recently. But I know that they're mainly interested at some point in buying a house. And she thought it'd be a good idea for me to come here and share some information with everyone to illustrate, what to do when starting the home buying process. So I'm going to break it up into a few different segments here. So Kim spoke about Atlantic Coast Mortgage, and one of the things that she mentioned to you guys was how Atlantic Coast Mortgage separates themselves from other lenders. They are correspondent lenders. So many of you probably bank with Bank of America, Wells Fargo, Capital One, some of those BB&T. Those are commercial lenders. So commercial lenders, what separates them is, they usually have a depository. So you can go in there, open up a savings and a checking account, money market account. Sometimes they have other loan products that you can open up with those banks. A correspondent lender focuses specifically on mortgages. So that's their bread and butter. They don't have depositories or any of those other products. And then you have brokers also. She mentioned brokers. Brokers would be like a middleman between a lender and an investor. So there's not that many brokers now in the area. There used to be a lot of brokers. So brokers have, they specialize in very unique, type of situations. So another thing that separates Atlantic Coast Mortgage from like a Bank of America or even like a credit union is the type of mortgage products that they offer. So everyone pretty much offers an FHA, which is a first-time home buyer program, and a VA for veterans, for military families, and then there's also conventional mortgage products, and they're all a little bit different. What Atlantic Coast does offer that some of these other lenders don't offer are other programs like the Vhda, which I'll talk a little bit about, and also the USDA and some other what we call hybrid loans that are more suitable for people that maybe they don't have the best credit or don't have a lot of money for a down payment. And these loan products are really great for people, and a lot of people that fit in that first-time home buyer model take advantage of these type of programs. So we'll talk a little bit about those as well. So I'll first talk about credit, since credit's very important. Then I'll get a little bit into the actual loan products, and then I'll talk about the real estate market, and then I'll open it up for some questions. So also, I don't know if we have a sign-up sheet, but if we do have we do. Okay, so if I have people's email addresses, I can also email a home buyer presentation, which will summarize a lot of what we talk about, and also some of the information that Kim brought in her flyers as well. So, alrighty. So credit. I get asked a lot, what's a good credit score, or what's a credit score do you need in order to buy a house? Does anybody here kind of have an idea of what good credit is or what a good credit score is? Does anybody know what their credit is here? Has anybody had their credit pulled recently? So you have? Okay, so would you consider yourself having good credit, fair credit, excellent credit?
Yeah, I have
Good credit? Okay. So it really depends who you ask. If you ask one of the credit bureaus, so there's 3 credit bureaus. You have Experian, Equifax, and TransUnion. Okay. A lot of people nowadays, they sign up with like Credit Karma, or maybe they have a Capital One credit card that they can track their credit score. Those are consumer reporting agencies. Okay, so they're good because they kind of give you an idea of what your credit is. However, if you go to Credit Karma, if you go to Experian, they usually only give you 1 or 2 scores. Okay, they very seldom give you 3. So when you go to Atlantic Coast Mortgage and you want to apply for a mortgage, okay, they're going to pull all 3 from all 3 credit bureaus, and their scores are actually going to be a little bit different than the consumer reporting agencies. And the reason why is because they factor certain trade lines a little bit different. Like if you have a student loan, or a credit card, or another mortgage, they weigh those a little bit differently. So some people get surprised when they say, oh, well, my credit score on Credit Karma is 720, and then when the lender pulls their credit, it's like 680, and they wonder, what's going on. And that's why. It's because they factor those trade lines a little bit differently. Go ahead.
What's the difference between the three? Like, which one out of the three is way more, or does it just matter?
Yeah, so as for, oh, there we go. So, is that better? Okay. So she was asking what's the difference between the 3 different credit bureaus. They're the 3, they're TransUnion, Equifax, and Experian. Those are the 3, when a lender pulls your credit, that you'll see each one has a separate score. So what differentiates the 3 credit bureaus is how they interpret the data that they receive. Okay, so for instance, I'll give you an example. You have a credit card with Bank of America. Bank of America is going to report to all 3 credit bureaus. Okay, every credit bureau, however, has a different scoring tier system. Okay, so sometimes they go up to 850 or 800 or 900. And also when you open up for instance, if you open up a credit card, or if you open up an automobile loan, sometimes they only report to 1 or 2 of the credit bureaus. They don't report to all 3. So that's why most people, 98% of people that I've come across, have 3 different scores. Now, if you ask a lender which one's important, they're not going to care. What they do is they toss out the high one, they toss out the low one, and they go by whatever the middle score is. So if you have a 740 Experian, a 700 Equifax, and a 680 TransUnion, they're going to go with that 700. Okay, that 700 is what really drives not only the mortgage product that you would be eligible for, but it also drives the interest rate that you would qualify for as well. So somebody with a 640 credit score is not going to get the same interest rate as somebody with a 780. So the key is to have as strong of a credit score as you can, because obviously that's going to open up your options. And I'll talk a little bit more when I get into these loan products. I'll give you an idea of what type of credit scores and credit factors they look for. Okay. Any other questions about the credit bureaus or credit scores? A lot of people don't know what their credit score is, that they've actually never really looked into it. There's a couple of different ways that you can find out what your credit score is. In addition to having like a Credit Karma or an Equifax account, if you go to annualcreditreport.com, okay, they will give you for free once a year. You can log in, and they will give you your credit histories. Okay, you have to pay a little bit extra if you want your scores. What I usually tell a lot of my clients is to go to the Experian or the Equifax website, www.equifax.com or Experian, and you can actually pay for what's called a 3-in-1 report. Okay, and that's actually better, because if you go to annualcreditreport.com, they'll give you the 3 different credit histories for each credit bureau, but then you have like 3 different stacks that you have to try to compare and figure out, what's what. So I like looking at all 3 on the same page. So I have Experian, Equifax, TransUnion. I see all 3 scores, and I see, who's reporting to whom. So if you have an automobile loan with BMW, it's going to report to maybe 1 of the 2, or maybe 2 of the 3, that type of thing. So, and it's a lot easier. But it'll also give you your credit scores, and it's like, I think it's $39.95 or $45, something like that. It doesn't really impact your scores that much, but what it does is it gives you a really good idea of what your credit situation is now. Because what you don't want to do is decide one day that you want to buy a house, and then you have the lender pull your credit, and there's things on your credit report that you have no idea what's going to show up. Sometimes there's a collection, an old Verizon bill that you didn't pay that, 5 years ago that's showing up. And now all of a sudden, it's a problem because you want to buy a house and they're reporting that collection on your credit report. Well, if you know that in advance, you can, find ways to work it out with either the creditor or with the lender. Will give you some ideas of what you need to do, what you have to pay down. Sometimes a lot of people have medical collections that they're unaware of. Lenders are usually pretty flexible with medical collections. But if you have like a recent collection or a major derogatory, like a bankruptcy or a foreclosure or a short sale, that can be problematic. Now, that being said, I've gotten people into housing from a bankruptcy, from a foreclosure, from repossessions, that type of thing. So it's not the end of the world, but you do have to reestablish your credit. And there's usually a waiting period, with the bankruptcy or foreclosure. That's actually another really good thing about Atlantic Coast Mortgage and other correspondent lenders is that their time frame for a bankruptcy and a foreclosure is different than like a Bank of America or Wells Fargo. So I think if I'm correct, it's usually 2 or 3 years removed from a bankruptcy and a foreclosure with Atlantic Coast Mortgage versus some other lenders that you may have to have like a 5 or 7 year waiting period. So that's a big difference. Okay, and then as far as credit too, some people think that they have great credit because they always pay their bills on time. So they charge up their credit cards and every month they pay down to zero balance or a minimal balance, and they think they're doing a great thing. But then when the lender pulls their credit, the lender will see that they're actually maximizing their credit. So for example, you have a Capital One credit card with $1,000 credit limit, and you use that card to buy groceries, to pay for your gas, maybe shop for clothes, and you charge $900 every month, and then you pay when you get your statement. You see you have a $900 balance on your credit card, and you pay it down. What's happening is what you don't see is that $900 is getting reported to the credit bureaus. So when the credit bureaus, TransUnion, Equifax, and Experience, when they see that information, what they see is 900 over 1,000, okay, which is a 90% debt ratio. They don't like that. So that's going to drive your scores down. So even though you're making your payments on time, your scores are actually going down every month because you're carrying a high debt ratio. And that's all the credit bureaus really care about. They don't know us. They don't know that we're good people and that we pay our bills on time. All they look at is debt rate. They have algorithms that they work with, and they look at the debt ratios and they look at your overall credit scenario. So what I usually tell people is keep your balances to about 30% or less. So if you have a $1,000 credit limit on a credit card, don't charge more than 30% on it, and then just keep using it. And then just pay it down every month. And it's usually good to carry a little bit of a balance, just $20-$30, because you're not paying a whole lot of interest on that, and then you're carrying that over to the next month. And when the credit bureaus see that information, they see not only that you're paying your bills on time, but you're managing your credit effectively. And that's what drives up your scores. So if you have 3 or 4 credit cards, do the same thing with all of them. Okay, keep the ratios down to about 30%, maybe 40. Tops. But once you start going over 50%, it's going to have a more so of a negative impact on your credit scores. So some things you can't really like with credit cards. You can manage those, but if you have an installment loan, like a automobile payment or a student loan, your terms are set. So you borrowed $20,000 for your car. Your payment's $400 a month, and so your debt ratios are always going to be high when you start. And then as you pay it down, your debt ratios will decrease. But the credit bureaus know that. They know that you have an automobile loan or a student loan, so they factor that differently than credit cards. So, and all those combined will determine what your scores are. Okay, so I'll talk a little bit about the loan programs. So is anybody here familiar with any type of loan program? David, right? Okay, what are you most familiar with?
The grants for the first 15-year
Okay, Grant. So he's probably talking about the VHDA product. Okay. Yes, ma'am. Sally Mae is student loan. So usually, I'm just gonna grab my water here. But yeah, Sally Mae. If you see Sally Mae on a credit card or a credit report, it's usually a student loan. You want to pay those. So yeah, there's a couple of things that are very difficult to work with on a credit report. One of them is anything that has to do with the tax lien. Okay, so or a judgment. If you have a judgment, it's going to be problematic. A tax lien is very problematic. If you have a private student loan, those you can actually work with some of those. But if it's Sally Mae, it's very difficult to work around those. So and I see people, especially people coming out of college with a lot of student loan debt, and they get into trouble also because you don't just have one student loan. Most people have 5 or 6 or 7 or 8 small ones that kind of add up, and then they may forget to pay 1 or 2 of them. And then all of a sudden when you pull your credit, that's when you find out that you're late on some of these student loans and they didn't roll over to maybe another loan that you tried to consolidate. So if you're in a situation like that, it's probably best to try to consolidate your student loans into something that's more manageable, because that I see that a lot as well. So okay, so the VHDA. So the VHDA is a Virginia Housing Development Authority, and I believe Kim has a handout that explains a little. Would you mind? Yeah, maybe we can hand out some package those. Yeah, I have those. I have those. So there are a couple of popular first-time homebuyer programs. One of them is FHA, which is a low down payment assistance program. Generally, you need to come up with 3.5% down payment on an FHA. And the other product is the VHDA. What differentiates a VHDA from FHA? A couple of things. VHDA actually is an FHA product in itself. However, they will help you with that 3.5%. If you don't have that 3.5% down payment in cash, VHDA will give it to you either in the form of a piggyback loan or a grant. So, and a lot of that depends on your credit score. So, if you have a 720 or above credit score, you can probably apply for the grant versus the FHA, the VHDA FHA product. Well, they'll still give you that 3.5%, but it'll be in the form of a piggyback loan. So, but both are great. So most people don't have 20% to put down on a house. A lot of people think that they need 20% as a down payment on a house, and that's not true. If you're buying a $300,000 house, 20% is $60,000. That's a lot of money. A lot of people don't have $60,000 sitting around. So, but 3.5% on an FHA on a $300,000 house is $10,500. That's more manageable. And then if you qualify for the VHDA grant product, 100%, you'll get the 100% financing, so no down payment. And then the only thing that you need to come up with is your closing costs. So when you buy a house, you have a down payment, and then you also have closing costs. Okay. One of the other printouts that Kim brought with her is an illustration of the closing costs breakdown for an FHA product and a VHDA product.
Just so that I get to everybody.
A lot of my first-time homebuyers have actually taken advantage of the VHDA. So it's a great program. If you want to buy in Maryland, it's the Virginia Housing Development Authority, so it's not available in Maryland. Maryland has a lot of their own first-time homebuyer programs, but in Virginia, VHDA and FHA are the more popular ones. There's also another one called USDA, which is Rural Development. And that's property specific, so it really depends where you want to buy the house. So, yes, ma'am?
On
Yes. So NACA is a lending program, and they also help first-time home buyers. NACA is a little bit different. So with NACA, you have to go through their program. Okay, so they have certain steps that you have to go through to qualify for the NACA product. But it is a lending product, and it's actually a very good lending product because you can actually minimize your interest rate with the NACA program, but you do have to go through their program.
Currently, in the program, I was trying to see like what people thought about it, and I think there's pros and cons.
Yeah, it's a lengthy program. So if you want to buy a house next month, NACA's probably not right for you because you do have to go through certain steps in their program. And my understanding now, because I have somebody that's working going through the NACA product, is that they're backed up a little bit because of COVID. So it's taken a little bit longer to go through their system. And it could be, a few months. I don't know, how long have you been in?
My case is kind of different
Mhm.
because I'm self-employed, so I'm waiting on my second year of tax
Mhm.
eligibility next year. So it kind of worked out because the process is long, but I needed a little bit longer to get certain things together. So I believe it should work out. But yeah, you're right about them being backed up.
Mhm.
COVID.
It is a good program if you're willing to go through the system and work it out. Also, another differentiator with NACA is they usually take a little bit longer to close on a transaction. So with a traditional FHA or conventional loan, Atlantic Coast Mortgage can probably close it out in 3 weeks. With NACA, they're probably going to want 45, 60, probably closer to 60 days to close. So I did one last year and it was about 60 days. So you might be able to get it in 45 days, but that makes a little bit difference too in the type of market. If you're in a really highly competitive market like we were 3, 4, 5 months ago, sometimes NACA may not be as appealing because of the longer time it takes to close on that type of transaction versus somebody who can close in 3 weeks. If you're a seller, you're probably, and everything else being equal, you might lean towards the person who can close in 3 weeks versus the person that needs a month and a half or 2 months to close. I think I was talking about the USDA. So yeah, USDA is property specific. So the property has to be in an eligible area. Now I think Stafford, parts of Prince William County, Stafford, Culpeper, Warrenton, those areas would be considered eligible areas for a USDA product, and it's another 100% financing product. So, they have their own website too. So if you want to take advantage of that program, and Atlantic Coast offers that program as well, you just plug that property address in there to see if it's in an eligible area. If it's not, then you go with the Vhda or the FHA. There's also a 3% conventional product, which is very appealing too. So if you have at least 3%, and does that worksheet illustrate that? If you do a side-by-side comparison between an FHA 3.5% and a traditional conventional 3% program, the conventional is always going to be a little bit better for two reasons. The biggest reason is mortgage insurance. Okay, when you apply for an FHA loan, the mortgage insurance is for the life of the loan. So the mortgage insurance premium on an FHA product is 0.85%. So on a $300,000 loan, it's probably going to be somewhere around $270 a month for mortgage insurance. When you do a conventional product, the mortgage insurance is tiered, at certain equity positions. So once you reach a 20% equity position on your mortgage, the mortgage insurance goes away on a traditional conventional product. With FHAs for the life of the loan, you would have to actually refinance out of that loan to get rid of the mortgage insurance. So that's another advantage with going a conventional route versus an FHA. No, I don't think so. So your score is what's going to drive the type of loan product that you qualify for. So there are lenders out there that will advertise that, they will accept people with like a 580 credit score. But there's usually contingencies built into that. So, it's a bigger down payment, much higher interest rate. Uh, Normally, most lenders want to see borrowers with at least a 620 or 640 middle score, because that will position you to qualify for more products. Now, ideally, if you have like a 720 and above, then you can apply for pretty much whatever program you want. So, but if you're in that 620 to 700 range, it really depends. So, debt ratios, credit history, and credit depth. So, with a lot of first-time home buyers, not only do may they not know their credit scores, but they also may not have a lot of credit history. So, I work with a lot of folks that like paying cash. They don't like credit. They don't like using credit cards. They don't want that liability. They don't want the headache. And that's great because you don't have, credit card debt to deal with. But if you want to buy a house, it's problematic because the lender wants to see that you have established credit. So, if you're just paying everything in cash, you're not really going to have a lot of credit history or credit depth, which is what the lenders look for. So it's always good to have at least 3 trade lines. So one of them typically needs to be older than 2 years, and then the other ones, just need to be open and used. So if you have a student loan or automobile loan that you've been paying for a couple of years, and then you have a couple credit cards, you're good. You'll have the score, and then when a lender pulls your credit, you'll have enough credit history for them to offer you a particular loan program. Yes?
Say, for example, like you mentioned, you pay things with cash. Can you get a secured card?
Yeah, so a secured card is another real good way of establishing credit. So I've worked with people that have no credit and people with bad credit. So rule of thumb, it's much easier to work with people with no credit and people with bad credit. So, because with no credit, you can establish credit. All you have to do is open up a secure credit card, like you said, use it, and within a couple months, you'll have a score. Now, that in itself is not enough to apply for a mortgage. You usually need a couple more trade lines. But once you've opened up a secured credit card and you start using it and it reports to all 3 credit bureaus, you'll start getting solicited from other credit card carriers to open up a credit card with them, and then you choose who you want. Some of them have annual fees, or real high interest rates. So you kind of pick and choose who you want to work with, and then it's all about just managing your debt. So, and then once you have the trade lines that you need and the credit history that you need to apply for a mortgage, within 6 months you can have a 720 credit score and be eligible to apply for a mortgage, especially if you're W-2. If you're 1099 or self-employed, I think in your situation, most lenders, they're going to want to see at least 2-year tax returns for people who are self-employed, such as myself. They want to see 2 years. And what they'll do is they'll average the 2 years. And they're going to go off net. They're not going to go by gross. So when you have W-2 income, they go by gross. So if you have a salary job, you're making $75,000 a year. That $75,000 will be used to qualify your income. But if you're self-employed and you make $75,000 gross, but then you write off $40,000 in write-offs, then you're only reporting $35,000 in income, and so they're only going to go off that $35,000. So again, if you're self-employed, you might want to think about that because. If you want to buy, a $400,000 house, you have to back a number out to say, okay, well, how much do I have to pay in taxes in order for me to qualify based on my current debt to income ratios to qualify for that property, that price point. So. And then there's also new construction. So some people, they want to go with a builder instead of a traditional, real estate, like resale property. And builders are a little bit different. So a lot of builders have their in-house lenders that they work with, and they'll give you an incentive to work with them. So if you go to Stanley Martin or Ryan Homes or one of those builders, they may say, hey, if you buy a house from us and you use our lender, we'll give you $10,000 towards your closing costs. Or we'll finish a bathroom on the lower level for you. So there's certain incentives to use a lender and or their title company as well. Builders are a little bit different also, so they have their own forms. So we use our standard real estate forms, but if we go with a builder, the builder is going to have their own forms that supersede our forms. But we look for a lot of the same language, and usually the builders will work it out so it's favorable for the builder, in terms of like the inspections and things like that. So, yes.
So as someone who's been in this industry for a long time, what would you advise someone, let's say for example a first-time buyer, would you advise them to go for building or getting a house that is already built?
It really depends, on what new construction. What appeals to people with new construction, it's a brand new house. Nobody's ever lived in it. You get to choose the options with the builder that you want them to build. But generally, new construction is more expensive too. And then the deposit is a little bit higher. So if you go to Stanley Martin, they'll have a model home, and then they'll have certain floor plans or models to choose from, and a lot. So you have to pick a lot in the area, and then when you pick a lot, you have to pay a lot premium. The deposit is usually higher with a new construction or a builder than with like a traditional resale. So with a traditional resale, earnest money deposit is usually right around 1%. But with a builder, it can be higher. It can be 3%, 5%, even more. So you got to have the money available. And the other thing is, if you don't end up buying that house, you're not getting that money back. So, and it becomes what's called a spec home, and that has happened. So if you go to a new construction community, and the builder says, well, I have a couple spec homes that I can offer you, that's what they're telling you, is that somebody had actually applied to build that house, put a down payment on it, and for whatever reason, they were never able to actually buy the house. So they lost the house, and it becomes a spec house, and it gets sold to someone else. So, and every builder is a little bit different, so to work with. So, and I've worked with a ton of different builders in the area. So, if you're interested in to working with the builder, let me know. We'll make an appointment with the builder, depending on the communities that they're building on, and we can go from there. So.
Thank you.
How are we doing on time, Joyce?
We can round off, because I have another speaker.
What time is it now?
Huh?
What time?
2 maybe.
It's 2? Okay, so, all right, so let me talk a little bit about the real estate market, because I am a realtor after all, so I just happen to know a lot about loan programs, because I was a lender for a while back in the day, and I still have my license, I just don't originate loans anymore. So, the real estate market, we were in a super crazy market, in the past year, and it's died down a little bit now. But and it was when I was showing Joyce properties for rent, and how there's certain stresses that come with that process. Now, just magnify that by tenfold, and that's what home buyers were facing in this other market, this housing market, because they were competing against several other buyers. I mean, I was showing houses that, easily had 10, 15, 20, 30 contracts on it within, a few days. And if you're a first-time home buyer with limited resources, limited down payment, maybe you need closing cost assistance, and you're going up against people that are coming in 30, 40% down payment, and they're waiving home inspections, they're waiving everything, it's very hard to compete. So, but now the market has turned around, there's a lot more inventory, so it's starting to balance out a little bit more. So home buyers are able to be a little bit more choosy about what they want. So it's a good time to buy. Certain things to look out for when you enter into a real estate market are contingencies. Okay, generally you're going to have a financing contingency and an appraisal contingency. So when you buy a house, you want to make sure that you're going to be able to get the loan that you're qualifying for, and also that the house appraises for the amount that you write the contract for. Because if it doesn't, you may have to come up with extra money to buy the house. There's also certain inspections, okay? I recommend, especially first-time home buyers, get a home inspection, okay? So the home inspection is basically your opportunity to learn everything about the house. And there's a cost for that, but it's well worth the cost to figure out if there's anything major, any major deficiencies wrong with the property that you can address. And if in a buyer's market, you can usually negotiate with the seller to help you with some of those repairs. You may have pest inspections like a termite inspection, or if you buy a house out in a rural area, you may have a well and septic inspection as well. So those cost money, and those are other things to look for. So one thing I get asked a lot too is what's the difference between a home warranty and homeowner's insurance? So when you buy a house, the lender is going to require that you get homeowner's insurance, you know, as a condition of getting the loan approved. So homeowner's insurance is for catastrophic situations. The house burns down, you have a flood, you get hail damage, that sort of thing. That you call State Farm or whoever your insurance is, and you submit a claim to get the property fixed. Home warranty covers your appliances, your HVAC system. So when you buy a house, especially if the appliances aren't new, there's a possibility that the refrigerator might break, in 3 months. The homeowner's insurance company is not going to care if it breaks. That's your problem. But if you have a home warranty in place, you can call the home warranty company and they'll come out and try to fix it. If they can't fix it, they'll replace the system, whether it's a refrigerator, a stove, HVAC. HVAC can cost $5,000 to $6,000 to replace. So a lot of people take advantage of a home warranty. Okay, so I think I'm running out of time, but if you have any questions, I'm happy to answer them as well. And then I also have my business card, so if you have any specific situations or scenarios that you want to discuss, I can certainly do that with you afterwards as well.
Quick question.
Yes.
How would you know the equity of the property you intend to purchase?
With the appraisal. So if a house is listed for $300,000 and you enter a contract to buy that house for, let's say, $320,000, because it's a very competitive market, the lender's going to want to do an appraisal on the property, because your loan is going to be based on the appraised value, not on the contract price. So if you buy a house for $320,000 and the appraisal comes back at $300,000, okay, the lender's going to say, you know what, I'm only going to give you financing based on the $300,000, not the $320,000. So that extra $20,000 would have to be negotiated with the seller. So, but that's how you determine and everybody has an opinion of value. So, the seller, the buyer, the real estate agents, the insurance companies, anybody that has a stake in the property has an opinion of what the valuation is for that property. But the appraisal is the most important valuation. That's the one that's going to stick. And if you buy a house, and let's say you buy a house with mortgage insurance and you want to not pay the mortgage insurance anymore, you've owned it for 3 years, you've paid down some of your equity or some of your mortgage balance. So, and that's another reason to get an appraisal. So when you do a refinance, the lender is going to order an appraisal as well to see if you have that 20% equity position in the property. And at that point, they'll waive your mortgage insurance as well. And I service pretty much all of Northern Virginia, so Loudoun County, Fairfax, Prince William, Stafford, Fredericksburg, Culpeper, Warrenton, King George, Spotsylvania. That's about as far as I'll go. So if you're looking in Richmond, probably not going to do that.
Thank you so much.